Hello, my name is Troy Atkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the second quarter of 2025. During the second quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University and the monetary policy actions of the Federal Reserve to help curtail the impact of inflation on the U.S. economy were the primary topics of conversation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 20 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, more than 8 years of freelance financial and investment writing experience, and more than 5 years of state government experience at the agency and legislative levels. I am also the author of more than 25 published financial and investment articles. Accordingly, I am a 2023 inductee into Marquis Who's Who. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. During the second quarter of 2025, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the U.S. residential housing environment. The following is an executive summary of the most pertinent findings. The U.S. housing market is in a period of deep contradiction and mounting crisis, defined by a historic wealth gap, frozen mobility, and rising systemic risks. A deepening divide. While aggregate homeowner wealth has doubled since 2010 to a near record $35 trillion, a growing number of Americans are being locked out or squeezed. Homeownership rates have dropped for the first time in 8 years, with young adults hit hardest. The affordability crisis intensifies. Soaring costs are the core driver. Home prices are up 60% since 2019, requiring an annual income of $120,000 to afford the median home, a 46% jump from 2021. Beyond mortgages, home insurance premiums surged 62% between 2018 and 2024, and property taxes rose 12% between 2021 to 2023, pushing 1 in 4 homeowners to be cost burdened. A frozen market. High prices and rates have collided with the lock-in effect of existing ultra-low mortgages, causing existing home sales to fall to a 30-year low. This severely limits mobility and supply. Inadequate and imbalanced supply. New construction is failing to meet the need. The multifamily building boom is ending, with starts down 35% from their 2022 peak. Critical affordable options, like manufactured homes, are being produced at only about 40% of 1990s levels. Supply is choked by high costs, labor shortages, and restrictive local zoning policies. The climate risk multiplier. Housing stability is now directly threatened by severe weather events, such as wildfires, floods, severe storms and tornadoes, hurricanes and tropical storms, hailstorms, extreme heat and droughts, severe winter storms, and bomb cyclones. 60.5 million homes are in areas with significant weather-related risk. The surge in billion-dollar disasters, up from 3 per year in the 1980s to 27 in 2024, is a primary driver of skyrocketing insurance costs and property taxes and property damage. Economic uncertainty looms. Proposed federal funding cuts and potential new tariffs on building materials threaten to increase costs further, exacerbating all of the above challenges. Overall, the market is simultaneously marked by record wealth for existing owners and record barriers for new entrants, all while rising costs and severe weather-related threats undermine security for everyone. The following impact study was created by ACM to provide an overview of the pertinent housing issues identified in the JCHS report. ACM believes the following categories have a high impact on housing. In terms of affordability and barriers, monthly mortgage payments are at very high levels, and large down payment requirements are necessary. This leads to a primary barrier to entry, locks out first-time buyers, and increases the wealth gap and reliance on family gifts for the necessary funding. In terms of home prices, the median price is 5 times the median income, up 60% since 2019. This severely erodes purchasing power, making home ownership unattainable for a growing share of households. In terms of existing home sales and mobility, sales are at a 30-year low. The homeowner mobility rate is at a record low of 3.1%. This leads to market stagnation, known as the lock-in effect, freezes supply, and perpetuates low inventory and high price pressures. In terms of housing supply, multifamily starts are down 35% from the peak level, and manufactured home shipments are far below historical levels. This leads to persistent supply-demand imbalance and ensures continued upward pressure on prices and rents. In terms of the homeowner cost burden, about 1 in 4 homeowners are cost burdened by insurance, taxes, and repair costs. This threatens financial stability for existing owners, increases the risk of distress, and reduces disposable income. ACM believes the following categories have a medium or low impact on housing. In terms of the home ownership rate, the rate of ownership has declined for the first time in 8 years. The largest drop is among under 35-year-old households. This signals a reversal of gains and a generational shift away from ownership. This will have long-term societal impacts. In terms of economic and policy uncertainty, there is a potential downturn on housing due to federal funding cuts and new tariffs on construction materials. These types of risks will exacerbate the affordability crisis and slow new construction, which in turn will add cost and investment risk. In terms of household growth and demographics, household growth is decelerating. The population is aging, and householders 80 years or older are expected to double in 20 years. This demographic change will alter long-term demand patterns, increase the need for aging-in-place supports, and may dampen new household formation. In terms of aggregate household wealth has doubled since 2010. Moreover, homeowner equity has more than doubled mortgage debt. This will provide a buffer for existing owners, but exacerbates inequality because wealth will be concentrated and not broadly accessible. Home ownership rates have dropped for the first time in 8 years in response to ever-increasing home prices, elevated interest rates, and an extremely limited supply of inventory. The total number of homeowner households is approximately 86.5 million. The number of U.S. households rose by 613,000 in 2024. The national homeownership rate is 65.6%. The national homeownership rate fell in 2024 for the first time since 2016, but is up from the post-Great Recession low of 63.4% in 2016. Homeowner equity averaged a near record high of $35 trillion, or roughly $400,000 per household. In comparison, homeowner equity was $23.2 trillion in 2019. Nationwide, aggregate homeowner equity is now more than double the aggregate mortgage debt level of $13.3 trillion. The recent rapid home price appreciation has provided substantial equity gains for many homeowners. Home prices are up 60% since 2019 and 127% since 2010. The housing cost burden for homeowners, which is defined as the number of homeowners spending more than 30% of their income on housing costs, grew by 646,000 to 20.3 million. Nearly 1 in 4 homeowner households are now cost burdened. To quantify the housing cost burden in the first quarter of 2024, a household needed to earn $120,000 annually to afford the median-priced home. In comparison, only $82,000 was needed in the first quarter of 2021. The housing cost burden trend is getting worse. Between 2019 and 2021, the number of cost-burdened homeowners experienced the largest increase since the height of the housing boom in 2005 through 2007. Homeowner cost burdens are increasing due to steep increases in insurance premiums and property taxes. Rising costs in these categories will threaten household stability. Home insurance premiums grew by 62% from 2018 to 2024. As of 2021, an estimated 6.1 million homeowner households were uninsured. Property taxes also increased an average of 12% between 2021 and 2023. The average annual tax bill is $4,380. Property taxes increased by an average of 12% from 2021 to 2023. Repair costs also strained household budgets. More than 27 million homeowners had unmet repair needs of nearly $98 billion in 2022, an average of about $3,600 per household. The housing cost burden that is attributable to natural disasters is also a significant problem for homeowners. The number of billion-dollar disasters has grown from an annual average of 3 in the 1980s to 27 in 2024, with damages totaling more than $180 billion. At least 60.5 million housing units are located in areas with at least moderate risk. 25,000 homes had major damage or were lost from Hurricane Helene and the Palisades and Eaton wildfires. The susceptibility of housing stock to the increasing damage from weather-related disasters is becoming an ongoing concern for the housing industry. Home insurance costs have surged in response to an increasing vulnerability to weather-related disasters. New single-family home sales climbed modestly last year, up 3% to 686,000 units. The median sale price of new single-family homes fell for the second straight year to $420,300. New home sales constituted 16% of all single-family home sales. New home sales were well below the pandemic peak of 822,000 units in 2020. Existing home sales fell to 4.06 million, including 3.67 million single-family homes and 391,000 condominiums and cooperative units. The annual sale of existing homes was at the lowest level in nearly 30 years. Existing home sales were down 34% from the 6.1 million homes sold in 2021. Existing home sales were lower than the 5.24 million average since 2000. The median sales price for existing homes was $412,500. Home prices are up 60% since 2019 and 127% since 2010. Home prices ended the year up 3.9%. In comparison, last year, home prices were up 5.6%. Since 2019, home prices were up 60% and 110% since 2012. 1.33 million existing homes were for sale in March of 2024, up from 1.1 million in the previous year. Inventories were 27% below the 1.82 million homes for sale the same month each year between 2015 and 2019. Since the 1970s, the U.S. has built an average of 16 million new housing units each decade. The pace of new single-family construction units rose to an average seasonally adjusted annualized rate of 1.01 million in the last quarter of 2024. New multifamily completions soared 14% in 2024 to 608,000 units. This amount is the most in nearly 4 decades. However, in 2024, new multifamily starts were only 354,000 units, down 25% year over year and 35% below the 30-year peak of 547,000 reached in 2022. The multifamily construction boom is ending. The number of multifamily units under construction tumbled in 2024. After climbing to an all-time high of 996,000 in 2023, the number of units under construction fell to 781,000 at the end of 2024, an annual decline of 22%. Manufactured home shipments numbered just 103,000 in 2024, a 16% increase from last year. Manufactured home shipments averaged 247,000 units annually in the 1980s and 291,000 in the 1990s. The average sale price of a new manufactured home was $123,000, excluding the cost of land. Housing supply is being curtailed by a multitude of complex factors. High interest rates and rising inflation were the most frequently cited challenges facing home builders. Other key challenges included the high costs and limited availability of developed land, the price of building materials, and the cost and availability of skilled labor. Restrictive zoning policies and regulatory policies for single-family homes further curtailed permit approvals. With this overview of the JCHS report in mind, let me now turn your attention to our analysis of the Federal Reserve's monetary policy. The general theme of this section is that the Fed has set forth hawkish monetary policy via higher interest rates to curb inflation. During the second quarter of this year, the Federal Reserve maintained its cautious approach to monetary policy, focusing on balancing inflation control with economic growth. The Federal Open Market Committee decided to maintain the federal funds rate at a target range of 4.25% to 4.5%. The Federal Reserve noted that housing affordability remained a significant challenge, driven by elevated mortgage rates, high home prices, and constrained supply. While some regional price stabilization occurred, broader market uncertainty persisted. The Fed emphasized the importance of housing trends in shaping its economic outlook. Due to a host of economic factors, the national average mortgage loan interest rate for a 30-year, fully amortized fixed-rate loan began the quarter at 6.65% and ended the quarter at 6.76%. The national average mortgage loan interest rate for a 30-year, fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17th of 2020 and the all-time high of 18.63% in October of 1981. In terms of the affordability challenge, as outlined in the 2025 JCHS report, housing affordability remained near historic lows. The combination of elevated home prices and mortgage rates kept many buyers on the sidelines, particularly first-time buyers. In terms of buyer behavior, demand remained subdued for most of the quarter, although a slight increase in buyer activity was noted in June, characteristic of typical seasonal patterns, as buyers attempted to lock in rates before potential later year increases. In terms of lending and origination activity, the second quarter brought a significant, seasonally driven rebound in lending volume. In terms of volume surge, total loan origination volume experienced a substantial increase, reported to be near 20% quarter over quarter, compared to the slow start in the first quarter of 2025. In terms of refinance activity, a significant portion of the increase was driven by refinance activity, which surged as lenders offered specialized products and borrowers responded to the stabilization in mortgage rates. In terms of the loan pipeline, the volume of new applications and pipeline activity climbed sharply, reflecting renewed lender confidence. With this overview of the Federal Reserve's monetary policy actions in mind, let me now explain the proprietary analytical methodology that was developed by Adkins Capital Management to analyze the home price level of the cities that constitute the Adkins 60 City Home Price Index. From a finance-based perspective, our proprietary valuation methodology analyzes the relationship between home price levels, household income levels, the percentage of pre-tax household income allocated to housing, and the cost of debt for a 30-year fixed-rate mortgage loan. From the first analytical perspective, our valuation methodology calculates the justified mortgage loan interest rate, which represents the cost of debt that justifies the home price level with the household income level, taking into account that 28% of household income will be allocated to servicing the mortgage loan. From the second analytical perspective, our valuation methodology calculates the justified percentage of household income amount, which represents the percentage of pre-tax household income that justifies the home price level with the household income level, taking into account the prevailing national average mortgage loan interest rate. The 56 overpriced cities in the Adkins 60 City Home Price Index were categorized based on their justified percentage of household income amount. New York City, San Francisco, Los Angeles, Newark, and Miami were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 6.76% to 0%. In addition, in terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities as underpriced, because prospective homebuyers would have to spend more than the respective justified percentage of household income amounts, which fall within the unrealistic range of 77% to 85% of household income. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $136,067 and $404,820. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $174,177 and $508,687. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, only 4 cities in the Adkins 60 City Home Price Index were classified as underpriced for the second quarter of 2025. Detroit, Jackson, Fargo, and Des Moines were identified as the top 5 most underpriced cities in the index. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 6.76% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 8.2% and 19.7%. Or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city to repay the cost of a mortgage loan. Now that our quarterly residential housing market review is complete, here is some valuable information that you should consider. First, you can conduct similar housing analyses for your community and for your specific home purchase opportunities by subscribing to use the Adkins Residential Home Valuation Analyzer on Amazon.com. Simply search for residential real estate software to watch our 15-minute movie presentation and to subscribe to use our software. Second, there is a wealth of additional housing information on the Adkins Capital Management website, including our comprehensive home price index, interactive map of city housing analyses, newsfeed of pertinent housing information, housing methodology patent application, reverse mortgage loan analysis, movie catalog of quarterly residential housing market reviews, housing valuation methodology presentations, and tactical and strategic residential real estate hedge fund model portfolio. By visiting ACM, you can gain valuable insights into the housing market and make well-informed home purchase decisions. This is Troy Adkins saying thank you for taking the time to listen to this presentation.